Majority. That's how many Fed officials now support potential rate hikes in 2026. This just dropped, and most investors don't realize what it means yet. Here's what's really going on and what you should be thinking about right now. Wednesday's Fed meeting minutes just hit the wire, and Wall Street's rate cut narrative is officially on life support. Most Fed policymakers are now open to raising rates further, not holding, not cutting, hiking. The WSJ, Reuters, and Forbes have all confirmed it. This is a coordinated hawkish signal, not a one-off leak. The 10-year Treasury yield spiked immediately. Bond markets are repricing right now. Every basis point matters. Equities initially sold off hard before clawing back. That whipsaw action? That's the market processing a regime change in real time. The trigger is persistent inflation. If price pressures don't cool, the Fed has just told us exactly what comes next. Growth stocks are getting hit. Higher rates mean higher discount rates, and that crushes the present value of future earnings fast. Meanwhile, cash and short-duration bonds are suddenly the most attractive they've been in months. Yield without duration risk. That's the trade the market is now repricing around. But here's what nobody is saying about this yet. The real story isn't the rate hike itself, it's the psychological shift. For months, Wall Street was priced to perfection around a soft landing and multiple cuts in 2025. That consensus just cracked. And when Wall Street consensus cracks, it doesn't bend slowly, it snaps. The repricing of risk across equities, fixed income, and credit spreads could be far more violent than a single rate hike would justify. We're not just looking at a policy change, we're looking at a full recalibration of market expectations, and portfolios built on the old playbook are dangerously exposed. First, reassess your fixed income duration. Long-duration bonds get destroyed in a rising rate environment. Shorter maturities limit your downside exposure significantly. Second, take a hard look at tech-heavy positions. High multiple growth stocks price in low rates. If that assumption flips, valuations need to come down, and the market moves before you're ready. Third, don't sleep on cash equivalents. T-bills and money market funds are now yielding real returns. In an environment like this, holding dry powder isn't a mistake, it's a strategy. The rate cut trade is on the ropes. The question now is how fast the rest of the market figures that out. What do you think this means for your portfolio? Drop it below. I read every comment. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.